Good morning, Bill.
This is FNC's Morning View, and we're talking this morning about interest rates, and in particular, spreads. We're not talking about food, we're talking about rates. So tell us about spreads.
Pimento, tuna fish.
It's all good, it's all good.
Well, what we've been observing is that historically the spread between the 10-year note and the 30-year mortgage has been running around 74 basis points.
Not 75, but 74.
Well, on average.
Three-quarters of a point.
Right.
For our listeners out there that may not know what a basis point is, because we have some that are not in the secondary markets, a basis point, 100 basis points is 1%.
Right. And so that's been going on for a long time. And of course it fluctuates, you know, as the 10-year drops, it may take the mortgage a little while to come down, or vice versa. It goes up faster than it comes down. But
sticky.
Yeah.
Like gasoline prices.
Yeah, more sticky in one direction than the other. But recently what we've been observing is that for some time now, over a year, that spread has been getting wider. It's been getting well over 1%.
That's called profit.
And 1.5%. Yeah, it is profit. But you know, there is this issue called competition, and you would think that banks would compete on that and try and get that down to so that they've got better rates.
Well, their production capacity is constrained.
Well, that's the issue. I mean, after the collapse, there were a lot of layoffs, you know, and their production capacity was reduced, and also now they've got a lot more constraints on them in terms of new regulations and requirements.
Yeah, because the production capacity is fairly sticky, it's constrained, and the question is, do they want to ramp that back up, or would they be happy, or happier, just to make more per loan and keep that constrained?
What do you think?
I think they'd be much happier to keep it constrained and make more per loan.
Well, that's certainly what we've been observing. I looked at the rates this morning, and this morning the 10-year was trading at 176, and if you add that 74 traditional average, that would mean the
2.5, give or take.
Exactly, yeah. So, but we're not seeing 2.5% rates on 30 years, and so
30-year mortgages.
Right. So
it's a little more.
Yeah, 3.5. You know, so that's an extra percentage point there. So, you know, just think of what the refi activity would be if it went down to 2.5.
Everybody would refinance again.
Yeah, exactly. And so if they did that, we'd be busy. All the banks would be busy.
Do you think the banks will open the floodgates like they did in 2003, or will they keep that constrained?
You know, I don't think they will. I think they'll keep it constrained as long as they can. I mean, I think like any type of competitive market, all it's going to take is for some aggressive lenders to go in there and start lowering rates, and then everybody will, you know, move to the same rate. But right now, I think everybody's happy staying where they are. I mean, if you look at capacity, they probably have more capacity than what they're fully utilizing right now, because we've just gone through 2 refi booms in the last couple of years.
And so think about it. If you lower the price, would you consume more? You think so? Up to a point.
Yeah.
I mean, that's what economists teach, right? I mean, does it apply to donuts?
And not only that, but it's what we observe.
Well, does it apply to donuts? I mean,
absolutely.
Can you eat a dozen Krispy Kreme donuts?
I could eat a very large amount.
I've eaten a dozen. Back to mortgages. Let's take the flip side of this discussion, and let's look at the back end of this. When a sale is a sale and not a sale and that sort of thing. Let's talk about that. Let's talk about banks getting rid of their problem properties.
Well, you know, we've seen a lot of issues in the press lately about some of the issues that are occurring. You know, you would think that banks, I mean, there's been a lot of encouragement from the government for banks to do short sales.
Now, I realize you read 2 publications. You read the Wall Street Journal and you read the New York Times. Now, which one is this from?
This one is from the New York Times.
Your favorite source. Okay, so talk to us.
Well, I mean, there was an article a couple of weeks ago by Gretchen Morgenson talking about a particular case of a short sale, not because this is unusual in any way, but more because it was sort of explanatory of some of the issues that are occurring. banks, in terms of origination, have a long history of building up their processes and their procedures and getting everything so that it's just, pretty finely tuned.
Right, get it.
But all of this foreclosure activity is brand new.
Well, they haven't had a process, really.
They really
It was
haven't, and
sort
so
of
they're
ad hoc.
feeling it all, so they're not internal systems to manage all of that, and so they make a lot of disconnects. And the example that she came up with was one down in Deltona, Florida, where a woman purchased a condo for an investment in 2007, paid 20% down, $250,000, did it from Countrywide, all right? But she got underwater on it, and she couldn't pay the mortgage, and so she needed to come up with some solution. She approached Bank of America about a short sale. She had an attorney. They discussed it. And February 8th of this year, it was approved for a short sale at $72,000. Plus, in the letter, it basically said they would relieve her from all liability going forward, and so she's going to end up losing her 20% down payment, and she's going to have a bad credit rating, but then she's done with it, okay? And so the requirement was that it closed by March 23rd, okay? Well, it actually closed on March 5th, so it early. But then on March 7th, after it closed, the bank rejected the deal. So on March 8th, they came back and said, no, it was approved. And then on March 11th, the attorney...
It was just different units in the
Different
bank.
units in the bank.
Right.
March 11th, they wired the sale back to the bank, from the lawyer, and then on the 20th, they rejected the deal again. The problem was that the new owner was already in the house.
Right, right.
And it all worked out well. The bank looked at it, figured everything out, and said, okay, yeah, everything's good.
But
and,
different departments don't
That's exactly right.
talk to each other because of process. It's a
Right.
process discussion.
And so the point of all of this is not to focus on any one deal, but to talk about the issue that a lot of these procedures are heavily regulated. They've got a lot of people looking over their shoulders, and it's very difficult to make all of this happen just the right way. And so
In a short period of time.
Right.
With a huge volume coming through.
Exactly. And so there are problems that they run into, and it makes it very difficult for everybody to be happy. And so you find these one-offs. But it points out the issue that right now with these, getting rid of these properties, closing out these foreclosures and managing all of this is not a simple task.
No, it's not. And it's made more complex by all of the regulations that have been passed as we have gone through this process.
Right, they're still learning and trying to understand these regulations, and a number of these regulations, even though they've been promulgated into federal law, have not been reduced to specific guidelines or requirements.
And if we're going to act by March the 8th, we have to have the regulations in place and know what we're going to have to do.
Right, and so, I would think that the lenders are somewhat reticent about making a lot of these deals because they don't know what's going to come back down the road and say, well, you really shouldn't have done it this way, you needed to do it this way. And then, so what are the implications of all that?
The implications of all that are we need to focus on pimento and tuna as opposed to other things.
There we go.
So this is FNC's Morning View. I'm Bill Rayburn with Bob Dorsey. You all have a fantastic day.